Money, money, money. Did you know that the bond market is almost double the size of the stock market? However, most investors don't even have bonds in their portfolio or understand how they work. Ray Dalio, the billionaire founder of Bridgewater, one of the largest hedge funds in the world, recommends you keep approximately 50% of your portfolio in bonds in his all weather portfolio. So, let's take a look at the bond market and see why this asset class is so important so you can start to incorporate bonds into your portfolio. What is a bond? A bond is a loan you give someone in exchange for interest, and in the end, you get your principal back. Bonds are usually issued by the government or companies to fund a new project. Bonds are made up of three main components. Number one, the face value, or par value, is the amount the bond is worth when issued, usually $100 or $1,000. Number two, a coupon, is the interest rate paid by the bond. And number three, maturity. Maturity is the length of time until you get the face value back, usually between 1 and 30 years. How to choose a bond? When we decide to buy a bond, we want to look at these three main categories. Number one, creditworthy. How likely you are to get your payments. Credit ratings are issued by several independent agencies such as Moody's, Standard & Poor's, and Fitch. Number two, interest. How much money you are making on a given dollar amount invested, also called the coupon rate. Number three, maturity date. When all of the funds need to be repaid, i.e., when your principal is returned back to you. An explanation of creditworthiness or bond ratings. Bonds are issued credit ratings by independent agencies, and the higher the rating, the less likely the company will default on its bond. An A rating is the highest and therefore the least risky. As the ratings decrease, the interest rates usually move higher, as investors demand a higher interest rate due to the increased risk. In general, investors want to buy triple B bonds and up because they have less risk of default. Double B bonds and below are considered junk bonds, and investors want to buy with caution because they have a much higher risk of default. Here, we can look at Standard & Poor's bond ratings for investment-grade bonds. Triple A is the highest quality, and anything lower than triple B is considered high risk or junk bonds. Are all bonds the same? No, there are several different types of bonds. The most common are government bonds. These can be issued by the federal government, such as U.S. Treasuries, or from municipal or county governments for, let's say, a building project. Federal bonds are considered the most secure because they are backed by the full faith and credit of the U.S. government. Another type of bond is issued by a corporation to raise money or start a project. So, why buy bonds? Number one, they can give you a fixed income or steady and predictable stream of income. So many investors buy them for stability. Number two, they are usually less volatile than stocks. Number three, if held till maturity, you get your principal repaid and get to keep all the coupon payments you received. What are some common risks of bonds? Number one, credit risk. The company fails to make a payment and defaults on the bond. Number two, interest rate risk. When interest rates are rising, older bonds start to lose value because the newer bonds are issued with higher coupons or interest rates. Number three, inflation risk. Bonds usually have a fixed payment. So as inflation increases, the purchasing power of your fixed income decreases. Number four, liquidity risk. When investors do not find buyers or sellers for their bonds. Number 5, call risk. An issuer might retire the bond early. This most often happens in a declining interest rate environment because the issuer can sell a new bond for a lower coupon or interest rate, so they buy back the older bond. How to buy a bond. Most brokerages have a bond tab or fixed income tab that will allow you to search for bonds. You can search by the 3 factors we reviewed today: creditworthiness, coupon rate, and maturity date. And now that you know what risks to look for, you'll be better informed when buying a bond. Wow! You learned a lot about bonds today. My name is Brad, and I've been investing in the stock market for over 10 years. I'm working hard to share my knowledge with you and help everyone become better traders. If you find this information useful, please like and subscribe so that we can get this information out to those who need it. If you are new to investing, I've created a Basics of Finance playlist here so that you can review any of these topics. And don't forget to join us next time as we review real estate investment trusts, or REITs.